and welcome back to another weekly webinar here at Route Consultant. If you've never been here before, you're here for the first time, my name is Josh Gregory. I am the director of our consulting and training teams here. And I work with both all of our new buyers who are looking to get into the space for the first time, and I work with contractors who are, I work with them all the time trying to help them find efficiencies and additional profitability in their own businesses. So I'm on both sides of the coin here. For all of our regular attendees, welcome back to another week. And again, whether you have been a contractor for 30 years or you just started today and this is your first day looking at the industry, we try to make these webinars a place where anyone can come and learn, ask questions, and hopefully have a little bit of fun and make sure that at the end of the day, you're feeling like this is valuable. So before I go too far and get started, I do have the quick disclaimer that I have to read as I do every week. So Route Consultant is not endorsed by and is not recommended by Federal Express Corporation, FedEx Ground, or Amazon. Route Consultant is not sponsored by, is not approved by, is not associated with, and has no connection whatsoever with Federal Express Corporation, FedEx Ground, or Amazon. All that means is that we're not going to be sharing anything that is materially non-public, but we do want to make sure that we're sharing information that you can use getting your questions answered. Now, a quick reminder for those of you who have not been to one of our new investor summits, we've got the last one of the year is in 2 weeks. So we won't have one next week right before Christmas, but as we get back after Christmas on the 27th and 28th of the year is our last new investor summit for the year. And it will be virtual, so you can tune in from anywhere. And what these are designed as is let's try to teach you as much as we possibly can in 2 days. And if you're on the fence about the FedEx industry, if you haven't really decided officially if this is the space for you, we've designed this summit as let's figure that out in 2 days, teach you as much as we can and help you make the informed decision on whether you want to move forward with the space or not. So if you have any questions on that, you can reach out to the team. We have the info in the chat already. That if you go to the chat, you can click and find out more about the event, but we only have a few spots left and this is the last event of the year. So if you've not attended, this is really your last chance to do it until next year. Now, general overview of how this will go today is we will go over some content, launch into a open Q&A. And if you've never been here before, when we get to that Q&A at the end, in order for us to answer your question, you first have to answer our question. So the question of the week this week that we'll need you to answer is, if you didn't have to sleep, so that was not something you ever have to do, and you got all of that time back every day, what would you do with those hours? Whether it's 8 hours and you're sleeping like you're supposed to, or even if it's only as little as 4, if you're 4 or 5 hours, like my nights sometimes are still, what would you do with that time if you had it back? So when we get to the Q&A, when you're typing in your question, first off, make sure you put that question in the Q&A button. If you put it in the chat, we'll miss it. So make sure you put it in that Q&A at the bottom of the window. And then when you're typing in your question, first type in the answer to our question, and then type in your question and we'll answer it. So before I get to our co-host and the content for the day, just a quick overview of the 2 new listings that came out this week. Both of these are line haul. So if you're looking for line haul, this is the week for you. One is in North Carolina, and it's 5 line haul runs at 1.75 million. And these are 5 dedicated solo runs with a manager with over 20 years of experience, 6 spare tractors, 6 spare drivers, and it may be eligible for SBA financing with some assumable truck debt options as well. So if you're looking for line haul in North Carolina, 5 dedicated runs, that could be the one for you. And then the next one is in Mississippi. That's 7 line haul runs at 4.2 million. And this is 7 dedicated team runs. So the last one was solos, these are teams. This one also has 2 spare tractors and it's being run remotely now. So if that's something you're looking for, even if you're not in Mississippi, this is one that could be run remotely. So those are the 2 options, the 2 new listings that have come out this week, North Carolina and Mississippi, both line haul. If you have any questions, reach out to the team. We can talk more about it. So today, my co-host will actually be Jake from OVD Insurance. not Jake from State Farm, but it is insurance. So I wanted to bring an expert on today to give us an overview of all of the required insurances if you're not aware of them. But I also wanted him on here to give some of the tips and tactics that he's seen over the years to help manage your insurance more effectively. So I will bring Jake on now. Jake, I see you there. Welcome to the webinar.
Thank you, Josh. Can you hear me?
Yes, I can.
Awesome.
Always the most important check.
Awesome. Perfect. And before you ask, I am not wearing khakis. Nope, not wearing those, but no, appreciate you having me on.
Yeah. So easiest way to start, if you just want to give a quick intro on who you are, how long you've worked with the FedEx and insurance space, and who OVD even is.
Yeah, of course. So my name is Jake Lazar with OVD Insurance. I help run our FedEx program here along with Steve Binnig and two other dedicated employees that solely work with FedEx Ground contractors. I've been in the insurance space for over 6 years. OVD Insurance has been conducting business for the last 40 years. I sit out of our Grand Rapids office, but we do have office locations in Pittsburgh and Raleigh. With that being said, we are a full service agency. So I do work with contractors nationwide. So we're not geographically limited with us just being out of the Midwest here.
Perfect. Yep. All right. So Jake, I don't want to go too in depth on everything, but I just wanted to do a quick overview for people who don't know, if they're getting into the FedEx space, what are the required insurances? And then what are the things that they don't need that FedEx covers? Let's just give a quick overview of what those are.
Yeah. So as of today, right now, the only two coverages needed required to be compliant with your FedEx contract are going to be the non-trucking liability insurance. So liability while your vehicles are out on the road, but not under dispatch. And then the other piece of insurance that's required is going to be workers' compensation. Everyone's employees are going to be W-2 employees. And so to be compliant with state law and also FedEx contract here, you're going to be required to carry workers' compensation. Now, when it comes to the non-trucking liability, I was very specific in my wording there with not under dispatch. So one of the great things about being a FedEx Ground contractor is that FedEx actually picks up what we call the primary auto liability. So every single FedEx Ground truck on the road carries the same DOT number on the side of the vehicle. And that means that you're operating under their authority. So anytime you're under dispatch, FedEx is going to be responsible and liable for any damages that occurs to another party, whether that's property damage, bodily injury, so if you strike a pedestrian in the crosswalk, you cause an auto vehicle accident, anything that you could be liable for under dispatch is a FedEx claim. The non-trucking is pretty incidental. We don't see many of those claims in the space, but they do occur. And that's going to be anytime that those vehicles are on the road, but not under the authority of FedEx. When it comes to vehicle insurance, what goes hand in hand with the non-trucking and what's actually not required anymore is going to be physical damage coverage. So this is going to be insuring the vehicle for either repair or replacement if it was to be damaged in a vehicle accident here. It's no longer a requirement. So if you do choose to self-insure that vehicle, you have the option to do that and pay out of pocket if you did total the vehicle in that situation here. The only situation where you would have to carry physical damage coverage is going to be if the bank, lending institution, or the company that you're leasing from is telling you that you have to carry it because you have collateral on that vehicle.
Perfect. Yeah. So, I mean, I think I heard you very clearly say right now, that's all those are the only required insurances. Is there one more that's coming?
Yes. Yep. So the last piece of insurance, and thankfully, I will say that most of the OVD clients were very educational in our onboarding process. So a lot of our clients are already compliant with the new standards that are going to take place here. But effective January 23rd of next year, FedEx is now requiring every single contractor to carry EPLI insurance, or sometimes we'll call it EPLI, or it's often called Employment Practice Liability Insurance. That's what it stands for. And essentially, this is a policy designed to protect you, the business owner, against any employee acts or allegations made against you for employment practices. So what does that look like? Sexual harassment, racial discrimination, wrongful termination, improper hiring practices. And then a more common one in this space is going to be wage and hour disputes. And so all those types of claim scenarios are going to be covered on an EPLI policy. When it comes to the requirements specifically, FedEx has three very specific line items that they need to make sure each policy contains. It's going to be $10,000 in wage and hour defense costs. It's going to be $1 million total policy liability limit. And then it's also going to need to include the ability to contact some sort of third-party law firm where you can reach out with general HR related questions.
Perfect. Okay. So hear this loud and clear. I know we've talked about it in the past before, but January 23rd is the date, right?
Correct.
Yeah. And for current contractors, hopefully this is not the first time you're hearing about it, but if it is, I would call your insurance broker today or call Jake and get it set up as soon as you can, because we're what, a month away from that date now. And then for all buyers who haven't gotten to the space yet, just be aware that if you're not seeing it now, that is going to be an ongoing expense and a part of the business moving forwards. And it is something you should expect to be paying for and covering until FedEx changes. But for now, that is something that you should expect. And it is on the whole a good insurance to have. We've recommended people to get it for years. We've had it for years. So this isn't necessarily a bad thing. It's more of just an information and an education thing to be aware that this is the new insurance that will be a part of your policy now.
Yeah, the policies are really cost effective. So, I mean, speaking generally here, because it varies by state, and then obviously, the size of contractor and the type of business that you're conducting. But relatively speaking, I mean, these policies are going to be anywhere from $1,200 to $3,500,000 for the general population here. And that's going to give you $1 million policy limit. And if something does come about, these policies are still designed to defend, even if it's a frivolous lawsuit. So we've seen it more often than not where claims have gone to mediation, there's been settlements, and we've seen those claims go in the hundreds of thousands. So you could be the best contractor with the best operations, the best controls in place, the best employees, and something can still come about from probably someone you didn't even hire. And it could turn into a $100,000 lawsuit just like that. So it's really important to talk about why we're putting these coverages in place. It's not just something that FedEx is throwing down here. It's really important to understand the why behind protecting you and your business.
Yeah, it's going to be even more important if any of you are buying via a stock purchase where you're inheriting all of the entity and all of the history of that entity. It is, as I can't underemphasize how critical it is to have these types of insurances in addition to a contract that protects you and indemnifies you as much as it can. Because then you may be liable for things that happened, years ago that you're definitely not aware of. Now, what happens, Jake, if my employee does something and they get sued and that comes back to me as an entity? Does EPLI cover that too?
It can. So not all EPLI policies are the same. And it's really important for people to understand that when you're going to the marketplace and you're talking to your current broker or you're talking to someone like Marsh here, that not all policies are the same, even though they might be compliant with what they're requiring from us in January. So that type of situation that you're referring to is what we call third-party liability coverage. And essentially it changes the wording in the policy here. It enhances the policy. And what it's doing is it's changing the type of claims that we would cover from employer to employee, and it's enhancing it where we're adding now third parties outside of your corporation. So if your employee were to make a remark to a package handler at the terminal, someone that's not from your corporation or even someone that you're delivering to, the EPLI policy will pick up on, discrimination claims, sexual harassment claims, something like that. So having that third-party liability coverage is really important. If you're going to pay for a policy already, you might as well have that included in it. And more often than not, almost all the policies that I encourage and put in front of my contractors here will include that language. And it's typically at no additional cost. It's just part of the plan that we put in force for them.
Because, if you're worried about you getting sued, 10x that worry if you think about all of the things your employees can do when you're not watching. So that is a very nice thing to have. Now, I have a few more questions for Jake that I'm going to ask, but if you have questions that you already want to go ahead and type in to the chat, you can get there. And once I'm done, we'll get to some of yours. And a reminder for everybody, the question of the day was, if you didn't have to sleep, if you gave up that time or if you got all of that time back, what would you do with those extra hours? So, Jake, just talking a little bit about workers' comp. So I know it's one of the biggest portions of the actual insurance expense that contractors will pay. So one of the biggest worries I hear all the time is, if I'm a new contractor and I'm buying a business where the previous contractor had really high rates because maybe they had, really bad safety scores or lots of claims over the years, is that an expense that I'm going to have to pay as well if I take over that business?
It's a great question, and one we get all the time here. So the first thing I ask is, what's the nature of the purchase here? If it's a stock purchase, we're almost always required to adopt the mod of the contractor that's selling the business, because you're inheriting all the liabilities of the business, all the contracts associated with it, and the insurance bureau is going to look at it the same way. So in that situation there, we would have to adopt the mod for a stock purchase, regardless of whether or not it's a favorable mod or not. If it's an asset purchase, it kind of depends on the nature of the purchase here. Typically, what we look at and what's usually approved when we do go to the bureau to adopt the mod itself is, are we purchasing at least 50% of the assets of the business? If that is the case, then usually we get the mod adoption to be approved. If that's not the case here, then we don't go forward with adopting the mod. It's not up to me as the agent, and it's actually not even up to the insurance company and the underwriter to approve that. It's something that's submitted to the NCCI, which is the independent bureau that monitors the experience modification factor. And to explain what experience mod is for those who don't know, an experience mod is basically a snapshot of your claims experience over a 3-year period. And so what they look at is they look at the claims that have been paid out over a 3-year period, or over what claims should have been expected based off of your peers that do similar businesses of a similar size here over that same 3-year period. And it basically forms a ratio. And so if we have, 75,000 in claims and we were expecting 100,000 in claims, the ratio is going to be 0.75. From there, how the mods actually apply to the policy, and this is where everything becomes relevant, is that factor, that 0.75 factor, is a multiplier on the premium you pay for your insurance policy. So you could be getting a 25% credit because you outperformed your peers by 25% over that 3-year period. Now it gets a lot more complicated than that, and there's other pieces involved, but that's the most basic way you can kind of break down what the mod is and how it's applied to the policy.
Perfect. So when, the mod score is something that is affected by things you do, what have you seen people do effectively to keep those mod scores lower and end up with lower rates over time? Any strategies you've seen there?
Yeah. So, when it comes to workers' comp, in insurance in general here, the name of the game is cost containment, and especially with work comp and FedEx Ground. So it's more of a matter of when it's going to happen, not if, because you're going to have claims. And they're going to come about, and whether your employees did something stupid or something out of their control, we're going to have to respond to that. And how we respond to that is actually the most important piece. And the term we like to use here is cost containment. We're going to have some costs involved, but how can we contain that cost? And it starts in a lot of different ways, and there's a lot of strategies involved there that I'd be happy to talk to people about. But really, one of the more important things is the timeliness of reporting a claim. If you don't report the claim in the first week of which it happened, typically speaking, we're going to see about a 40% increase of the lifespan of the cost for the lifespan of that claim. So you're paying almost 50% more, or the insurance company is going to be paying almost 50% more for a claim just because it wasn't submitted on day 1, day 2, all the way up to day 7 there. So just encouraging those habits of, as soon as something happens here, make sure that your employee is receiving the care that they need to receive at the time, and then making us, your agent and your insurance company, aware of what happened so we can get that reported. Now, some things are unavoidable, and you're going to have employees out there that injure themselves and they're going to be missing some time. So when we look at an employee that's missing time here, we have to start to look back and say, all right, well, what can we offer this employee to get them back on the job as soon as possible? And that really revolves around putting a return to work program in place for your employees. And that looks different for contractors in different states for the nature of the injury, whether they can still drive a vehicle, whether they can't drive the vehicle. And so we can work on strategies there for again, containing the cost by putting a return to work program in place. So the lifespan of the claim is significantly shortened and they're back to work a lot sooner than what was originally anticipated there.
Perfect. Can you talk a little bit about the strategy, talking cost containment of paying only, a portion of the claim, paying the medical part of the claim versus the indemnity, and what that looks like and why somebody would do it?
Yeah, so when the experience mod is calculated, if it is considered a medical only claim, meaning your employee, we did not pay for lost wages, or we'll often call it indemnity. You might see that on loss runs there. Whatever was paid on a medical only claim is going to be shown as 30% of the actual claim itself when it comes to calculating your experience mod. So a $10,000 med only claim is only going to show up as $3,000 paid out when your experience mod is calculated there. Relative to if it turns into an indemnity claim there, well, then you lose that 70% credit when calculating the mod, and then they're going to look at the full cost of the claim itself. And again, this kind of goes back to reporting it in a timely manner. Like if we knew about it right away, maybe we could, get different type of care than knowing about it. Some more realistic examples here are 2 months later. So, with keeping that in mind, having a 70% reduction and only showing 30% of the claim on your mod is huge, especially when you're a contractor that has high frequency, because the underwriters that we work with like to look at frequency over severity there. So if you have 10, 15, 20, 50 claims a year and they're not being reported in a timely manner, they could have been med only, but they weren't medical only, that ends up adding up pretty quick.
Yeah. Okay. So getting off of workers' comp a little bit, I know that physical damage insurance is not required. But there are plenty of people, I'd say probably most people do still use some kind of physical damages insurance for their vehicles, but there's the option around self-insuring now. So
yeah,
why would someone decide to go that route? Like how does it make sense financially to insure things myself versus paying an insurance company?
Yeah, so that's a great question that needs to be asked on an individual level. It depends on your risk tolerance. So again, the next question we have to ask is, will my bank allow me to do this? If I have any sort of debt on my business, are my vehicles used as collateral? If so, more likely than not, the bank's going to tell you what you have to at least require on your vehicle. And then from there, to your question here of self-insurance and what does that look like? And kind of the questions that we start to unpack here is, can your business tomorrow financially recover from totaling your newest vehicle, or a vehicle that's on the most important route, or a vehicle that you have do exclusively commercial pickups, or what have you? Do you have cash on hand to recoup that? Do you have cash on hand to have a 2-vehicle disaster within a week or 2 weeks, or what have you? So those are kind of the questions, and I know those are worst case scenarios. So but it's important that people understand that the risks they're picking up on when they decide to self-insure. So we do have clients that fully self-insure their fleets, and that's how they like to operate. And we can tell them the costs associated with the reduction in premium. If you are comfortable with saving 12 grand a year on your insurance premiums, and kind of rolling the dice on the 10 vehicles you have on the road, great. I think a lot of it depends on your cash reserves and how risk adverse you want to be. So the best thing I can do as an agent is really empower my clients and let them know the costs associated with self-insuring or even partially insuring, because these are all going to be stated value policies. So if you do have a step van that's going to be $75,000 brand new with all the equipment in it, maybe you choose to only insure it for $45,000, and you're fine taking the savings on the insurance and only getting the payout of the $45,000. So there's a lot of different things we can do. It depends on how risk adverse you want to be, but we can walk through those with you.
Yeah. And I think the thing that I want everyone to hear here is that there are, there's insurances that are required, and there are kind of minimum checklists that you need to follow to be compliant. But there's a lot of nuance and a lot of ways to structure insurance and these policies in a way that benefits your business the most, beyond just kind of cookie cutter answers. And your insurance broker or your agent should be able to have these conversations with you. So that should be one of the first things you do. If you've never talked to your agent outside of that initial purchase, So those are conversations you should be able to have. And an initial red flag that if you're thinking to yourself, I don't have a person, I know the company, but I don't know any person that I could call, that's a red flag on either maybe your strategy around insurance, but also it could be just has to do with that particular provider. There may not be a person for you to call with certain providers. So that's why I try to go, I want everybody to see that there are a lot of these little things that you would never know about, but can save percentage points of profitability at the end of the year. It's not trivial amounts. So that's the main thing I want everyone to hear loud and clear right here. And we're going to get to some more questions now, Jake, but before we do, you have to answer another question first, which is the question of the day, which reminding everyone is if you didn't have to sleep, what would you do with the extra hours?
What would I do with the extra hours? So over Thanksgiving weekend here, I went into a local bakery and they do fresh bagels every day. And I walked in and the smell just hit me. And I was like, if I could just wake up to this smell every day. And so I think, honestly, I just have a side hustle of doing a bagel shop or a bakery or something like that, just to get that constant bagel smell going on.
There are very few bagel shops in Nashville, if you would believe it. And it's something we're missing. We had one and it immediately went out of business. So I feel like that's maybe our fault too. But yeah, so that's great. My answers are always not very good because I know the answers that I would like to give here of how productive I would be, but I know also that there's a good chance I would just spend it on watching more TV or reading probably. That would give me a good excuse to read more often.
Josh, what are you watching these days? What's your show?
What am I watching right now? Survivor. Oh, the finale's tonight. That's what I'm watching right now. The finale of Survivor. So it is still going. For those who didn't know, we're on season
44.
44, yeah. 3 or 4, yeah. So it is still going strong. That is my show tonight.
Nice. Love
it. But yeah, that's how I'd spend the time. So we'll see if anyone else has better answers. The first question we have here is from Chad, who did not answer the question. I'll still answer your question, but send your answer in, Chad. So this one looks like it's for me. So talking more about peak for line haul and how do we think about valuing the business around peak season and including peak incentives. So just in general for line haul, peak is a little bit different than P&D. You can think about it conceptually. For pickup and delivery, you own a set of zip codes. And so during peak season, there's, tons more volume from everybody ordering the additional packages around Black Friday, Cyber Monday, Christmas. And so your zip codes, you're responsible for delivering every package and stop in those zip codes. And so your volume's just gonna, go crazy and you have to keep up with it, staff up for it. Line haul is different. With line haul, you only have a contracted set of runs. And so there will be more volume during peak season, but there's nothing contractual that you are required to do as a part of your current contract. And so it does look a little bit different. There will be extra volume you can take if you have additional resources. You will talk with the terminal about it. But the main thing is that there will be a threshold. And if you do more miles than that threshold, you will get paid additional for those miles. Now, when it comes to thinking about valuing around peak season, if you've looked at any of our listings, we don't include peak season at all for a very particular reason. One, it allows the projections to be a little bit more conservative, but two, peak's going to look different every year. Volume's going to look different and your expenses to keep up with that volume will look different. And so, when we're actually valuing a business, we don't include it. And, there can be more revenue there. If you're trying to think for yourself what it could be, the best way to get a sense of that is to look at hopefully a few years of peak season settlements and see from a percentage basis about how much the revenue increases during those years. But in general, there's a lot of kind of randomness and change and variety that happens during peak season that makes it really hard to properly project. So instead, from a conservative buffer standpoint, we do not include peak season. And Chad, the question was, if you didn't have to sleep, what would you do with the extra hours in your day? And then we've got another one here from Brian. He said he would exercise, and that's a good answer. I was thinking about this earlier. If I had like 8 additional hours in my day, I think there's a really good chance I would eat more. And that's 8
Come to my bakery.
yeah, you're opening a bagel shop, so that's not saying any good odds there. You don't get the time where you don't even get the chance to eat because you're awake, so you're burning calories. So that's an opportunity for failure where you need to exercise as some of those additional hours to make it. But Brian's question here first is, do you provide workers' comp in all states?
We do. Yep. So I was just making sure that was the question.
That's the first one.
Okay. So OVD, we are licensed in all states here. And I currently have clients in just over 40 states. To be completely transparent, one of my personal goals this year was to work with our friends in Alaska and Hawaii. Unfortunately, FedEx kind of stopped that from happening by canceling the contracts in those 2 states. So yes, in the lower 48, we do. There are 4 monopolistic states, Washington, Wyoming, North Dakota, and Ohio, that are state-run facilities. So as an agent, I can't generate work comp quotes because those are run by the government. But outside of that, I have the ability to, and I have insurance programs that are proprietary to OVD, and then other insurance programs that are kind of open source that are nationwide. So we can work with anyone in any state.
Perfect. And then his follow-up is there much variance in the workers' comp rate state to state? Is there a huge range there?
There is. So to answer the question directly, it does vary by state for a lot of different reasons. Each insurance company has to file their rates with the state, and rates vary by state based off of employment laws, based off of claims experience, based off of a lot of different factors there. A contractor in California is going to be paying a lot more than a contractor here in Grand Rapids, Michigan, just because of the nature of the state and the laws associated with it, the cost of doing business. So, and that's going to be true for a lot of different states. Midwest is generally going to be a little bit less than other states there. So it does vary by state, but then I'll go a step farther and say it varies by insurance company. So in our program here, I work with over 20 different work comp companies alone. And each workers' compensation company has different appetites and different types of clients they want to work with. And they have a sliding scale of pricing that they work off of too. So, and that's why I represent over 20 different companies, is because their pricing is different and who they want to insure, who they don't want to insure. And so there's going to be some variance once you do get on the state level, and what that looks like.
Okay, we've got another one here from John, who said that he would read, which again, I agree. That seems like a good use of time. So if you're new, trying to get into the space, how soon does insurance need to be set up? What's the process for your first time? How early does that have to be done?
Yeah, so when setting up an insurance plan, there's a period that we call data gathering, where I ask for a lot of information. What I don't think is a lot, but what you might think is a lot. Actually, relative to what a bank's asking, it's probably not much. But I do need to gather some information, and for me to do my due diligence in terms of going to the marketplace on your behalf, explaining your story to my underwriters, getting the most competitive quotes possible. Typically, we want to work at least about a month out to your stand-up date. And that's kind of, again, the minimum is ideal there. Obviously, there's been deals I've been able to do next day. And I don't really want to advertise that, but we can make stuff happen if we have to. So really, if we're looking at a new stand-up here, one of the first questions I ask is, when would you like to stand up, and when do you really think you're going to stand up? And then from there, we kind of back into, these are the pieces I need from you for me to do my job. And then it takes us about 2 weeks to go to the marketplace completely and get quotes. And then from there, we walk through the proposal and onboarding process there. With how FedEx works from a compliance standpoint, you need to be fully compliant, meaning all your insurance needs to be submitted to FedEx the Wednesday prior to your Saturday stand-up date. So everyone's going to be standing up on a Saturday. That Wednesday going into it, you need to have your insurance documents in. I like to have those sent into FedEx about a week before that stand-up there. So that's kind of the timeline. It takes us about 2 weeks to gather quotes. Another week or so to work through those quotes and then get everything issued for our clients.
Yeah, and definitely want you all to hear that. There are some vendors that, you can look at afterwards, you can get set up whenever you want, but if your insurance is not finalized, FedEx will not allow you to close. So Wednesday before, but just remember, and when we're thinking key vendors, insurance has to be done. It's not a let's talk about it and figure it out. They will say, okay, we'll push it back a week until it's done. Next one is here from Chad, who's answering the question from before. Also, he would spend more time with his family. That is a great answer, and definitely one that I think we can all agree on. So for line haul, when I'm doing an asset purchase, do the points earned come with the business? Yes, you will be able to transfer the points balance, even if it's an asset purchase. There's still a process for that, so those do not get lost. And that's important because that's, those are months, years of time built up on those tractors that you definitely want to transfer. It's part of the value of the business you're buying. Now, this one's from William. With his free time, he would learn a new language. That's one of those that, during the pandemic, what's Duolingo? I tried that for a while with multiple ones, and it's a good system. I always end up dropping it. And I feel like I just have accepted my fate. I was one of those too who learned Latin in high school. So my language experience is very low. But his question was, when you see people selling routes, you see that they overstate expenses. And as an example, tax returns showing fuel that's higher than the fuel statements. While I don't often see fuel as one that's really different than what's on the settlements, it could be that there is some fuel or some vehicles that were not a part of their deliveries, but they used in their business that, could make fuel different. It could be a personal vehicle or maybe a manager vehicle that wasn't tied to the FedEx business, so it wouldn't show up on settlement statements. So the fuel would still come out. Just as a general rule, though, if you're looking at contractors in the FedEx space and looking at their tax returns, they will almost always be, very low income or negative if they have a good accountant at all. This is a very tax advantaged business. So you will very often see, plenty of expenses, they're small businesses too, things you can run through the business to get that number very low or negative so that you don't have to pay any taxes. So often the best kind of way of figuring that out is getting the add backs from the seller or their accountant to get a true sense of what the real expenses were and what were the things that they just kind of ran through the business to end up with a negative income for their taxes. Next one here is another one from William Hudson. So answering the question, he said that he would finally like to write the next great novel, but like me, would likely end up spending his time watching YouTube and TV. So I think we're in the same boat there, where I have high aspirations of what I would do with an additional 8 hours a day, and also a realistic interpretation of myself and knowing what I would actually do with it. So Jake, you mentioned Washington State as kind of a self-moderating body for workers' comp. So if you were talking to someone who is new to FedEx, setting up their corporation in another state versus Washington, do you have any option there if you live in Washington State? Is there any way that you can incorporate outside of Washington and not have to pay the insurance captive rates in Washington, or anything else like that you can do?
Yeah, that's a good question. So, and that's actually quite common. We see that all the time. So it's very possible, and many of our clients do this, where you live in a state, but your business of operations is in another state. I see it all the time. So yes, I mean, if you need to purchase workers' compensation wherever you're conducting business. So if you live in Washington, but you have employees in Oregon, we're going to have to set up a workers' comp policy to insure those employees in Oregon because they're W-2 employees. It's not monopolistic. And so we have to go to the marketplace and make sure that we have workers' comp coverage for those employees. Yeah, we do it. We do it all the time. I have contractors that operate in over 6 states. And so we have to make sure we have all 6 states covered on our policies based off of where they're being dispatched out of. That's how we make sure and keep track of everything that way. So yeah, it's a non-issue if you are in a monopolistic state, and we can still do the other coverages too. So we have clients in Washington and we do their non-trucking and we do their EPLI. It's just workers' comp. That's where it just varies a little bit. But it's really a non-issue when it comes down to that.
And his follow-up question is, not to speak good or bad of individual states, but if you had to say what are the best, the most insurance friendly states and then the least insurance friendly states, what would you say?
Oh boy. The Midwest, for the most part, we're going to ignore Illinois. The Midwest, for the most part, is relatively friendly when it comes to rates. So Indiana, Kentucky, even Michigan, you're going to see some pretty generous rates when it comes to pricing. But it's just like any business, the cost of doing business. So your settlements are going to adjust because they count, they account for it like they do for everything else, of course. So that's going to be accounted for. But yeah, in terms of the cheapest rates, you're most likely going to see it in the Midwest. And then, with most expensive states, and this isn't a reason not to conduct business in those states, but California, New York, Louisiana actually has some of the toughest laws for workers' compensation. And Louisiana, believe it or not, is a really hard state to competitively offer rates in for insurance companies. We have clients in Louisiana. We can do it all day long. But believe it or not, it's just a state that you're going to see higher rates in. But again, it's accounted for. So I'm not going to say you shouldn't do business or shouldn't purchase routes or should move your business because of the rates in your state.
And one of the important things Jake mentioned there is that when FedEx is creating the contracts, they're trying to account for the expenses they expect you to incur from things like state laws and insurance, rates in that individual state. So, if FedEx's algorithms are perfect, everything is the exact same. But if you're looking at kind of an insurance strategy, there are better and worse states like Jake talked about. Another thing I've seen is there are some states where, they're not super friendly to business. So FedEx does pay a little bit higher on the contracts to account for it. But if you can get a contract in a low cost of living part of that state, a high expense state, but you're in a cheaper area, sometimes those can be really good contracts because you're getting the compensation for that higher expense state, but you're paying lower wages. And workers' comp is also a function of payroll. So there's that you can end up with kind of playing the system a little bit there and ending up with some good contracts in certain areas.
And with there's always exceptions to the rules. So with that too, there's some states out there, and I just want to highlight this because there's a lot of people in Florida. There's states like Florida and Wisconsin that are like rate states. And essentially the rate is set at the state level. And it doesn't matter which insurance company you work with. Everyone abides by that rate. And that's a state level thing. So we call those rate states because you're carrying the same rate regardless of who you're working with. And then at that point, the conversation is, the billing, the claims handling, how am I being serviced, other things like that. So there are some states where you can't even negotiate. You just have to do what they say.
It's just a part. You don't get any say. You just accept it. Those are the fun ones. Okay, another one here from Mike. Just a quick one, and it's actually really relevant for right now. If anyone who's running during peak season, what kind of insurances, if any, do I need if I'm renting a vehicle?
It's a good question. So when renting a vehicle, what the rental company is going to be concerned about, of course, is their truck they gave you and the physical damage coverage on their vehicle. The insurance program that we offer, that a lot of contractors are in outside of Marsh's program, of course, basically with how they operate and the best way to conduct it here is insuring that rental vehicle and scheduling it on your insurance policy to the full value of cost new. Rental companies are notorious for nickeling and diming people. They're notorious for ripping people off. And so the best thing that we can ultimately do here is insuring for the vehicle like new and having it scheduled on your insurance policy. And then once the rental is returned, we take it off the policy at that point in time. But of course, we're concerned about the repair of the vehicle, but then also the replacement. If you choose to purchase the coverage through the rental company, typically it's really expensive. But there is one benefit to doing it that way. If you do it that way, it saves you the headache of one, filing a claim with someone else. But two, it's not picked up on your insurance. So like we wouldn't know about it because you're filing it with Penske or what have you. So if you'd rather pay a little bit more to not even deal with, having it covered under your broker's policy here, that would be a benefit to going that route there.
Perfect. All right. So if we don't have any other questions, I will end it here. We're basically out of time anyway. So a quick pitch, and you've got about 30 seconds for those of you who may be frantically typing in your last question. A reminder, I mentioned it at the beginning, but if you are a new investor and you've never been to one of our summits, the last one of the year is in 2 weeks. And it's the 27th and 28th. It's virtual. You can attend from anywhere, and it's designed. If you've never been if you haven't decided on pursuing the FedEx space, it is a 2-day crash course and teaching you everything we possibly can to help you make that decision on, okay, this is the industry for me. And it's, I always tell people if you can spend 2 days and, help avoid $1 million mistake, because it's not the industry for you, that's always going to be worth it. Now, we did just share a way for you to reach out to Jake in the chat. So if you're looking for that, if for some reason that doesn't work, you can reach out to us and we'll make sure you're connected. But other than that, thank you so much, Jake, for coming out today and for being here to answer everybody's questions. We always appreciate having you. Appreciate it, Josh. Yeah, thanks for having me on. Really enjoyed it. All right. And for everybody else, we will see you next week. There's only a couple more webinars left in the year. So we will see you next week. And everybody have a great week. And if you're not here next week, have a great holiday. Merry Christmas. See ya.